Good evening, everyone. Thank you so much for joining me and Laura from Harris Associates this evening to talk about value stocks, value investing. My name is Min, and I'm the head of research at Endowus. Before we get started, we have to go through a couple of disclaimer slides for each of the jurisdictions that we operate in. The first one here is for the Singapore audience, and it's just really to let you know that this presentation is for information purposes only and should not be considered as an offer, solicitation, or advice for the purchase or sale of any investment products. And then the next couple of slides are actually for our Hong Kong audience, pretty much telling you the same thing, that is just to be taken as information for use for information only. Next slide, please. We want to make sure that this webinar is as interactive as possible so as to be of more use for you. So please send in your questions on Slido. On this slide, you can see the URL and the password as well. It's Natixis. Next slide, please. Thank you. This is just a quick plug for Endowus. At Endowus, our mission is to help everyone, from someone just starting out in the working world to a mature adult with a family, and someone who is maybe just getting ready for retirement and starting to enjoy the fruits of their labor. Why should you invest with us? Because we offer you the cheapest share classes after trailer fees. We charge a flat and low transparent access fee. And last but not least, we eliminate that conflict of interest that you may have seen or experienced with other traditional competitors. We don't try to sell you products that are expensive or have you sell in and out of investments so as to generate more sales charges. We don't even charge a sales charge. So you can buy and sell anytime, anywhere, whenever you want. Next slide, please. We work with all these very well-known fund managers, including Natixis and Harris Associates, to give you access to some of the best investment strategies in the world at the lowest possible cost. Next slide, please. We are backed by world-class investors. Some of the names that you see here: UBS, Citi, Lightspeed, Singtel, Samsung, Prosus, SoftBank, etc. So you can trust us because they trust us. Here, I'm going to turn you over to our guest speaker today, Laura Rieber, to introduce herself and Harris Associates. Over to you, Laura.
Great. Well, thank you so much for having me today. Maybe a quick introduction of Harris first on the next page. So Harris Associates is a Chicago-based value equity manager. Value equities is all we do, and it's all we've done since inception. So the firm actually started out with roots in the 1940s. Entrepreneur Irving Harris, an American entrepreneur, he had a home perming business, and he sold it to Gillette, and he needed a process and philosophy to be able to manage those proceeds, and he chose that which was invented by Benjamin Graham in the 1930s, that of value investing. And so in 1976, the firm was formally founded as Harris Associates. We began to take outside capital from investors, but essentially using that very same process, long-term value investing with a concentrated approach to maximize our stock picking skill. In 1995, as the original founding partners decided to retire, we were acquired by Natixis Investment Managers. So just a bit on Natixis. Natixis has about 15 plus specialized investment boutiques that we own. Harris is the value equity manager within that suite, currently manages across all the affiliates about 1.3 trillion USD. So that has been a really stable and good partnership for us over the years. We are still an affiliate of Natixis Investment Managers. And so Harris Associates as a firm, as of the end of March, manages $104.5 billion. And about half of that is in dedicated US equity mandates. So if we kind of look all the way back through our history, we've really been investing in investment in US equities since, again, the late 1940s. We started up our kind of global non-US equity capabilities in the late 90s. But again, a substantial portion still in dedicated US. So a little bit about myself. So the team at Harris is all, based in Chicago, all of the marketing, sales, et cetera. And so being out here in Asia, my role is really to be able to, talk to clients, prospects about the investment views of Harris Associates, our positioning. And so I partner with the Natixis Investment Managers sales team, where we have offices all, throughout Asia. I sit here in Singapore. And so Natixis is a great partner for us here in Asia in terms of distributing the Harris Associates capabilities.
Great. Thanks, Laura, for the introduction.
Yep.
Yeah, so it's really great that it's based in Chicago, because that's when I first got familiar with Harris as well.
Yeah.
Maybe just to start the conversation, we can talk a little bit about what's been going on in the markets. So if we could just bring up the slide on Magnificent Seven, thank you. So really, there's been a lot of interest because of their past performance. This is a 3-year return chart. You can see that there's a purple line that's going up, up, up. And then the others are the other 6 of the Mag 7 and S&P 500 index returns. You can't see, but there's a dark blue line. But you can see that they're pretty much clustered. These stocks have actually outperformed the peers in the mega cap space. The purple line is the stock that starts with N. Many of these companies are beneficiaries of the rise in AI, either through direct investments, such as Microsoft with OpenAI, or being an integral component of the boom in investment in AI technology and infrastructure, such as NVIDIA with its essential chips. Next slide, please. What is interesting, I think, and something that maybe people think about or don't think about, is that these 7 stocks actually make up about 30% of the S&P 500 index weight. And on this chart, you'd see that the circles are the larger circles, the darker colored circles are all clustered on the left-hand side, which shows the individual weight in the S&P 500 index. But along the vertical axis, which is the return of each stock over the past year, you see that it's actually a lot higher than the remaining 493 stocks that's all the way on the right, the tiny orange or yellowish circle. So it just goes to show that these 7 stocks and the 3 other stocks in the top 10 have really been powering the S&P 500 in terms of performance. These stocks are also incidentally termed growth stocks, usually. And while we saw value stocks do incredibly well in the rally of the late 2020, the growth stocks have since made a comeback. There is always this perennial debate of growth versus value, but today we have an expert in value investing, Laura. So we'll turn to Laura to maybe talk a little bit about Harris Associates' philosophy of value investing, because they're actually very well known for value investing. And so Laura, maybe you can tell us and share with us how Harris Associates see value investing and what the approach to it is.
Yep, there we go. So I thought it would be interesting just to start out because I think the definition of value has kind of evolved over time, and certainly value means different things to different investors, to different firms. I think if you look all the way back again to the 1930s, when value was essentially, invented by Benjamin Graham, value and growth were really thought of being as kind of quite distinct. And that's because book value used to be quite closely tied to business value, and then earnings were much more volatile and correlated to stock prices. So essentially what that meant, and essentially this is what Benjamin Graham kind of invented, is that you could buy stocks at a discount to book value when earnings were low, and then essentially patiently wait for better times when the price will climb back to book value. And so this worked well at the time because the US really was an industrial economy, and so physical assets were much more tied to book value. And fast forward essentially to today, the business value is much more tied to intangible assets. So things that really aren't on the balance sheet, like research and development, sales and marketing, et cetera. So essentially the strategy of just buying, a stock at a discount to book value and waiting for the price to catch up to book value is not really as much of a reliable strategy as it used to be. And so essentially today, though, many people think of value kind of still along those same lines, buying less competitively advantaged, maybe poorer quality stocks at low PB, at low PE ratios. And we don't really think about it like that at all. I mean, certainly some stocks are trading at low valuation ratios, and if they're structurally disadvantaged, they deserve to be trading at those ratios. And so we would not consider those, kind of value investments. And at the same time, we think that buying a great business at an average price is just as much value investing as buying an average business, at a great price. So while we do often own, and in fact in our portfolios today, we have much more kind of what you would think of as traditional value stocks. There are times when the market really undervalues growth, where you have higher growth stocks that kind of start trading like value stocks like they did in 2022. We are not prohibited from kind of investing in those type of stocks. So on the next slide, this talks just a bit about our kind of tenets and what we really consider our investment philosophy. So really, there are three things that we look for in any investment that we make. First, we're really looking to buy businesses at a significant discount to our estimate of intrinsic value. Secondly, we want to invest in companies that are growing per share business value at least as quickly or at least as fast as that of the S&P 500. And third, we want to invest with management teams, that are capable and aligned with shareholders. And I think it's really important to also highlight the point about per share value, because that's really aligned with us as shareholders. If we have a company that doubles its market value, but then also doubles its share count, that really doesn't do anything for us. So essentially our starting point is that as owners of the business, we the management team should be, returning the free cash flow back to us as investors in the form of dividends and share repurchases, unless they really have the opportunity to invest, that capital in competitively advantaged parts of the business that are expected to kind of earn excess returns.
Thank you. Oh, sorry. Go ahead, Laura.
Oh no, didn't have anything else for that. Yeah.
Yeah. So I guess maybe let's just stay on this slide and we can dive a little bit deeper into intrinsic value, because there is a question from a member of the audience. Is there a uniform way to calculate intrinsic value, because different industries and sectors have their own little nuances?
Yeah, so we do use discounted cash flow for most of our companies. And so that means we project free cash flows out, 5+ years. That being said, we do triangulate these calculations with other metrics. And as the question correctly states, different industries might have different metrics that are more appropriate. So if you look at, a typical consumer company, for example, often PE is the most relevant metric. Sometimes you could be looking at a company that's more early in its kind of life stage. And so kind of looking at companies that are not quite yet profitable or maybe even unprofitable, it might be more instructive to look at something like a price to sales, or maybe like a price to user ratio, and compare that versus other companies in the industry. For banks, oftentimes we look at price to book. And then there are some cases where you have, businesses where you have kind of a core business that is profitable, and then you have other businesses which aren't yet profitable, where it might be difficult to do kind of a DCF. So in those cases, again, we might look at, other comparable companies in the industry or business units and try to value that out. And then we kind of add the different business components together. So we're really not kind of defining a single, metric when we look to value a company. It really differs, again, from industry to industry, but at least DCF is sort of the one standard that we typically tend to use with all of our companies for the most part. And then again, triangulate with, kind of M&A ratios or public comparables, et cetera, private market valuations, to make sure that we're kind of in the ballpark of what's reasonable.
That makes sense. Maybe just also staying on value, because I see that in the investment philosophy for Harris, there are three components: value, quality, and management. So
Yeah.
just staying on the value part, and then you already kind of described how Harris sees value, but just comparing the philosophy of Harris and the way you think about value investing to others, so that some of the clients may be familiar with systematic investing value. So really just looking at one metric to identify value stocks, and also maybe index funds that are investing in the value universe. How would you differentiate Harris from some of these value funds?
Yeah, so I think a lot of value funds, and certainly many of our peers as well, they're looking more at kind of statistically cheap ratios. So again, the low PE, the low PB. And I think the limitation with some of this, especially when you look at maybe like a more quantitative way of screening out names, is that it actually largely ignores intangible assets. So intangible assets, as I sort of mentioned before, these are assets that certainly have, value in the future. But when a company spends on intangible assets, that spending is essentially expensed right away. And you contrast this with if a company buys, like a building or a physical asset, that expense is depreciated over time. So it doesn't hit the income statement right away. So I think really the limitation with just looking at, again, kind of headline ratios is that it ignores some of these intangible assets. So if a company is investing, say, heavily, in R&D, this year and next year, that's going to really kind of impact their earnings. It's going to depress their earnings. The PE ratio, might look quite high. So that might, if you're looking at traditional screening, that stock might be excluded because it doesn't look like a value stock. But if I think about the fact that, okay, that R&D is potentially going to be benefiting the company for the next, 10 to 20 years. And so I take that expense and I, rather than expense it right away, I amortize that over the next, say, 10 to 20 years, then looking at PE ratio over the next couple years is going to look a lot cheaper than it would be if I just, again, took the full expense of that R&D spending. So essentially, we don't rely essentially just on screening because we think that we can miss a lot of companies that way. And so we really take the time, especially for, again, kind of some of these companies that you might typically think of as growth companies. Sometimes you will see them in our portfolio because when we do try to value out intangible assets, a company can look much more like a value company to us.
That's helpful. Thank you. We have another question from somebody in the audience too. The person is asking, what are the different types of value? Now, I know you've already kind of gone through it, but maybe just to really make it a little crystallize the concept, would you mind just repeating that? Thank you.
Yeah, I mean, I think the way that I guess we think of value is more like intrinsic value investing. And so I think the traditional, I guess, value investing, that I kind of mentioned before is really thinking about, okay, like a lower growth company, they're paying out most of their earnings as dividends. They're perceived kind of lower quality businesses, statistically cheap valuation ratios. I think intrinsic value investing, I think on the other hand, is while you're looking at a business, you're valuing out what is this business worth and where is the stock trading. So essentially that means, if I have a company that I think is much higher quality than the average company in the S&P 500, and that company is trading at a market multiple, that could be a great value for us because I'm saying, well, it's trading like an average company, but it's not an average company, it's an above average company. And as opposed to buying maybe a lower than average company at a very attractive price, which again, it might be more traditionally thought of as value investing. So I think that our definition is a little bit kind of broader, a little bit more flexible. I think some people speak of kind of like growth as a reasonable price. So that's another maybe kind of like convergence of the two. I think for us, we kind of, play in both in a sense, because we certainly do invest in, many traditional value names, but we can also invest in like discounted growth as well. And so sometimes that term gets thrown out, or sometimes you have some managers that might really focus on, reasonably priced growth companies. And so that could be thought of as in some ways another style of investing, but really focused on higher growth companies. So for us, again, we try to keep, I think, our investment universe as broad as possible, which actually works quite well for us, because if you look back again to 2022, we had a lot of kind of higher growth companies that were selling off, maybe 50%, something like that. And I think, the concern was on, higher rates, higher inflation. And then you had a lot of companies, a lot of growth companies that actually weren't even profitable. And so those were kind of selling off because the market realized, okay, this company's not actually making any money, but it was super expensively valued. But then on the other hand, you actually had profitable tech companies, even tech companies that are more mature, they're already paying out dividends, and they were just falling along with the other companies that weren't profitable. So that really gave us an opportunity to pick up some of those names, and our performance certainly benefited from that. And then in 2023 and coming into this year, as a lot of these higher growth stocks really outperformed, essentially they hit our value targets, and so we've sold out of many of them. And now when you look at our portfolio today, we're much more in kind of the traditional value space, because we don't think that kind of a lot of the growthier stocks are as attractive. So that kind of allows us to kind of move with the market. We don't have to be stuck in a box when potentially growth or value are out of favor. We can kind of play in the part of the market that looks attractive. I mean, it would be sort of pretty unusual that we'd have a portfolio full of growth stocks. I think typically we're more kind of traditional value, but we have the ability to pick up some of these kind of discounted growth names when the market provides the opportunity.
Thank you, Laura. And I think, just to kind of repeat what you just said, there are basically a few different types of value investors. So there are the deep value discount, super discounted value investors who really look at super cheap, statistically cheap stocks. And then there are traditional value stocks, kind of like what Laura is showing on the slide here. And of course, there's relative value, or some people call it closer to the GARP style of investing, which is growth at a reasonable price. And that is kind of where Harris can move between the different buckets. So wherever you are seeing intrinsic value that's cheaper, that's where the fund manager and the team would be investing in. Mm-hmm. Would that be right, Laura?
Yep, correct.
So maybe just going back to the previous slide on how you think about the investment philosophy with value, quality, and management. And now that we've covered value in quite a bit of detail, could you talk a little bit more about the quality and the management and how you look at those?
Yeah, so we are, again, we're really looking kind of 5 to 7 years out, and we want to understand really what are, the drivers of the business. I think sometimes you have growth that is more cyclical, something that depends more on the cycle. So that could be, for example, an auto company. The growth is more cyclical, but the company is still growing. And then you have kind of more advantaged growth, like, for example, an internet company where they're benefiting from kind of the secular trend of advertising moving online. So we have the ability to invest in both types of companies. We would typically cap, an internet company at a higher multiple, because essentially we think that it's worth more, and we would cap like an auto, for example, at a lower multiple. But the important thing is that both of these companies are growing, and I think capital allocation plays a really important part of that, as I mentioned before. So I think you would expect some of the higher growth companies where they might be having more kind of investment opportunities to expand the business, to invest in higher returning endeavors versus some of the banks, energy companies, et cetera. We would expect, because they are kind of typically lower growth industries, that they would be returning, more capital, back to shareholders. So we really want to understand a company and their path to per share value growth. I think a lot of times what happens is that, the market will kind of panic because, a company might have, missed earnings, or they might be kind of sort of like a cyclical downturn. But when we look kind of further out, we still think there are prospects for the company to grow over time. There are kind of secular drivers there. And then in terms of management teams, yeah, we're really thinking about those shareholders those management teams that are aligned with us. And so oftentimes that means that they're incentivized along with the shareholder. So that could be that they own a lot of the company's stock. So we really like to see management teams that own a lot of stock. That could be, their comp could be tied to the share price. So for example, I know some companies like the CEO will get paid more if the stock reaches, a certain price. I think what we don't want to see is that management teams that are essentially rewarded for just growing the company without thinking about profitability, or that are just trying to make their jobs kind of bigger and bigger. So essentially, again, we really think about capital allocation and how they are doing so in a way that's advantageous to shareholders. I think another example of something that tends to be a little bit of a red flag for us is that companies that are making, expensive acquisitions where we think that this is not really value additive to shareholders, sometimes that capital is just better spent returning it back to shareholders or doing share buybacks, especially if the stock is cheap. Then that means you kind of, you benefit just because you're buying back the stock at a discounted price, and then shareholders benefit because you're essentially shrinking the denominator. And so you get to share the profits amongst a smaller shareholder base.
That makes a lot of sense. And, just getting back to what we talked about with the Magnificent Seven and how narrow the market is in terms of market leaders.
Yeah.
And if you are a value investor,
Yeah.
where your approach is somewhat similar to Benjamin Graham or Warren Buffett, how should you approach this environment? And, how should you think about whether some of these tech stocks, are they overvalued, undervalued? How would you approach this?
Yeah, so maybe I don't know if I can control the slide to a couple slides back. There's one slide that says significant portfolio changes. I think it's a little bit further on. But essentially, I think exactly this one. So essentially, what we are finding today is that traditional value stocks are a lot more attractive. So you can actually see here, I mean, we just chose a few sectors to kind of highlight. So you can see, information technology, for example. So information technology, and as you mentioned before, it's 30% of the S&P. So typically as a value investor, we've kind of, I don't say always, but we typically tend to be overweight, especially in this environment where tech kind of represents a lot. But you can see that kind of around 2022, early 2023, we were at 12.6%, which was a pretty high weighting, at least relative to history. And then as we've kind of progressed into this year, the weight has really decreased. And that's because we're just not really finding as much kind of value in the IT industry. We've just found a lot of stocks, a lot of, the Mag 7, et cetera. A lot of those are tech or tech related type of stocks. So we're not finding as much opportunity there. And we're finding much more opportunity in, I think, some of the like traditional, value type of names. So it's interesting because the market, there is sort of this bifurcation. You have, some part of the market that's done really well, as you mentioned before. And then you actually have a lot of the market that's been kind of left behind, so you have stocks that are, they don't comprise a large percentage of the S&P 500. They are in industries that are much less represented in the S&P 500 than tech is, and they're trading at much lower multiples. So healthcare is kind of an interesting example because healthcare is a sector that we really like, and sometimes we have trouble finding opportunities in the sector because a lot of times when there are recession fears, investors tend to flock to safety. It's less sensitive to the macro. So you can see here we had a pretty low weight in 2022 because there were a lot of recession fears. And so investors were kind of flocking to these sectors, like utilities, healthcare. At least they didn't sell off as much as tech or financials, et cetera. But what we've seen in 2023 is that as the market is kind of increasingly priced in a softer landing, some of the defensive sectors have actually lagged, and so it's provided an interesting opportunity for us to kind of top up our healthcare exposure. But I think overall, it's interesting because sometimes you have, low PE stocks that are really kind of concentrated in one part of the market. But right now, what we're seeing is that, again, because of the dominance of the Mag 7, et cetera, is that a lot of the cheap stocks are actually in a lot of different industries. So when we look at some of the names that our team has bought across our US strategies over the past year and a half, it's really been, staples, energy, financials, industrial. It's been a pretty broad set. So we do think it kind of provides an interesting opportunity today. Whereas again, we will always happy to own some high quality tech companies if the opportunity presents itself. But right now, it's not really where we are finding the most value.
Thank you. So just looking at the portfolio, it looks like you're finding value actually in healthcare, energy, among some of the other sectors instead of in IT, for example.
Yeah, and the reason we showed this slide, we have a lot of financials, for example, too. So financials is like 40%. Essentially, the reason why we showed this slide is just because you can kind of see some of the changes over time. And so if I look at our portfolio, again, especially kind of relative to the end of 2022, I think healthcare and energy is kind of one of those areas where we have increased exposure, whereas IT we've decreased. But certainly financials, communication services, these are other kind of areas that we also have, exposure to.
Maybe just, switching from sector to, say, market cap. We've seen small caps underperform large caps. It's been that way for more than a year, I think.
Yeah.
Especially in the US and developed markets for sure. How would you think about small caps versus large caps when it comes to value investing?
Yeah, this strategy, at least in our US strategy, our minimum market cap is about 5 billion. So we typically are kind of a larger, cap strategy. I know in our global strategy, we do have the ability to kind of go a little bit further down the market cap spectrum. So I think, there is value to be had. I think if you look at kind of the mid cap market, it's interesting because I think there has been a lot of reasons why, smaller mid-cap stocks have been penalized. And actually, if you consider the fact that, there are, profitable names, within that group, there's been some concern about debt, et cetera, the impact of rates. And there are certainly names, that are profitable where you can kind of exploit the fact that smaller mid caps have been kind of depressed, or they've been, underperforming large caps, for a number of years. If you look back on a trailing, 1, 3, 5, 10-year period, they've mainly lagged, the larger part of that market. So, we have, I guess some kind of exposure in more of our global portfolios, but for the most part, this tends to be probably a larger cap portfolio. But that being said, we certainly have probably a wider range than what you would sort of see in, the top 10 of the S&P that represents like a large part of kind of the universe.
Got it.
Yeah.
All right. Thanks for that insight. Maybe just switching back again to sectors, because there's a question here. And I know you mentioned that the market is already pricing in kind of a soft landing.
Yeah.
But what happens if that's wrong and we're in for a hard landing? Which sectors do you think would outperform?
Yeah, so typically when you have kind of recession fears, when you're going through an economic contraction, if there's a hard landing, the sectors that tend to do well are those that investors kind of perceive to be defensive. So that would be healthcare, staples, utilities. sometimes it could be energy, but it really depends on what's kind of what's kind of going on with the energy market. Energy does tend to be, more cyclical, but sometimes if there's sort of supply constraints, energy can do well, as it did in 2022. So, I mean, at Harris Associates, we don't sort of position for really economic outcomes, but I think that oftentimes, what happens is that when you have, difficult years. So if I think about 2018, for example, 2018 was a year where there were a lot of concerns about recession fears. That's when all kind of the trade rhetoric was going on. And so the market was really running to safety. So again, a lot of those sectors that I mentioned, healthcare, staples, utilities, et cetera. And so what happens in those type of markets is that we really think that sometimes the market overbids those sectors and they become quite expensive. Also, there's sort of the search for yield. Sometimes these, kind of yield sensitive names, when rates have been low in the past, they were kind of bidding up some of these defensive sectors as well. And so in a year like 2018, it was interesting because cyclical sectors, on the other hand, were performing, quite poorly from a stock perspective, but from fundamentally, they weren't actually doing, too badly. So that was sort of an interesting opportunity where we were really underweight to defensive sectors because we saw that they were becoming expensive. I think in this environment, I think what has been nice is that, again, because you have the market kind of pricing in a softer landing, it has given us the opportunity to pick up more of those defensive names than perhaps we might have had in other years. But so as I mentioned, I think it's really the defensive sectors that would be expected to do well, but we don't really kind of position explicitly for that outcome. And in fact, that's a lot of times what kind of tends to provide opportunity for us and being a little bit more contrarian.
Got it. Contrarian is good.
Yeah.
It can really, be rewarding sometimes.
Yeah.
So talking about market cycles, there's the belief, or some people would say, that value strategies tend to do better in the early part of the cycle after a recession. We saw that happen in late 2020, when all the really cheap stocks started to really rally. I mean, part of it was the meme stocks, but aside from that, and then, when you get to probably the middle part or the later part of the cycle, then it's more relative value or growth stocks are starting to outperform. Where do you think we are in the cycle, and how does Harris, I know you're flexible around the value investing spectrum, but how do you navigate those changes?
Yeah, so we essentially, a lot of times the economic cycle kind of provides us kind of opportunity. And where we are in the cycle, I mean, it sort of depends on the industry, but if I think about, for example, the agricultural equipment industry. So because we found a couple of opportunities there, essentially we've had a couple of pretty good years. And so now management teams at these companies are forecasting a decline in agricultural equipment sales, but kind of around where you would expect, kind of mid-cycle to be. So kind of expecting kind of a reasonably good year, but clearly a decline from the years past. And so I think some of these types of stocks, essentially, they've become weaker because people are concerned that we're kind of going down the cycle. And that's where actually, again, these kind of situations provide a little bit of opportunity for us. And it's also the same, if I think about like the RV, recreational vehicle industry, I think that's another one where you've had a couple of kind of strong years of growth, and now we're kind of normalizing. So I think that's where we are. Again, it depends on kind of the company by company, industry by industry, but it seems that for many or select industries that we're investing in, we're kind of getting back to kind of what we might think of as like mid-cycle or normal. And so because we're kind of looking further out, sometimes when an industry is kind of, sales are expected to decline maybe over the next year or two, but we think that, over the next 5 to 7 years, there's still a story. This actually provides us kind of an investment opportunity. I think historically as well, value stocks have really tended to be more of the economically sensitive or cyclical stocks. And I think that's why they've tended to do well kind of early cycle. I think what's interesting, again, as I've been kind of alluding to, is that now the value stocks are a little bit broader. You have healthcare, which can be considered value stocks. You have staples, which can be considered value stocks. If I were, again, to look back to 2018, what was a value stock? Financials, autos, industrials, the really cyclical names. So I think that's again why those types of stocks might have done better kind of in the early cycle. But again, what's nice is that we kind of have a broader set of stocks to choose from than we might have had historically when value names, were much more of the economically sensitive cyclical types.
You mentioned healthcare. How would you think about biotech? The only growth spot in that value defensive.
We don't own really much in the biotech space. I mean, I think it's interesting because we actually found some opportunities in kind of the life sciences sector because there were concerns about kind of the biotech, kind of the funding cycle, and sort of where we were at there. But I think more of the names that we have been investing in have been more along kind of life sciences. And part of that is because, I mean, yeah, the market pricing in kind of a softer landing, but the life sciences industry is kind of coming out of a couple of years of also kind of outsized growth. So some of, like, if you think about COVID, some of the companies providing like diagnostic, COVID tests, or some of the life science instruments companies where they had a couple of years of good growth and now they're kind of coming back to normal, and the market doesn't like that. So some of those names have been becoming a bit more attractive. So I guess if I look at the healthcare space, that's where we've had a little bit more of our kind of new ideas rather than biotech.
Got it. Thank you. There's a question on diversification. So let me just kind of rephrase it. So this person was saying that Ray Dalio recommends diversifying to over 20 non-correlated instruments to avoid drawdown in a particular year. So can you apply that to diversification in stocks? Does that help, or does it have to be, I guess, is 20 enough or 25 enough? How do you think about diversification in the context of this equity portfolio?
Yeah, it's interesting because so our most diversified strategy, so our US equity strategy, for example, we have about 40 to 60 stocks. And I think in the industry that might be considered like relatively concentrated. I think a lot of our peers might have over 100 stocks, but 40 to 60, that's kind of our more diversified portfolios. And we also have more concentrated portfolios, and those have about 20 to 25 stocks. So exactly like you said. And I think essentially, whether investors choose to go in the more diversified or more concentrated, it really depends on kind of your appetite, and your tolerance, for volatility. I think the nice thing about having a 20 to 25 stock portfolio is that you really get the higher conviction names. So if you really can get those right, obviously we're not going to get all of them right, but if you can get, a fair amount of them right, those are the stocks that we would have, the highest conviction in. And we do think, 20 stocks is diversified enough. Otherwise we wouldn't be offering, a portfolio that's as concentrated. But clearly, again, from year to year, you might just have, more lumpiness, because I think on one side, yes, your winners are going to, have a better impact on the portfolio, but then your losers are also going to have a larger impact on the portfolio. So I still think, for 50 to 60, some investors just prefer that because they don't like the volatility of a 20 stock portfolio. But certainly, as we do offer, US global portfolios that are more concentrated, that is an option in some of our strategies.
So it's really just a matter of how punchy you want your investment strategy to be.
Exactly. And I think we also agree that, 100 for us, 100, 200 stocks is for us, at least, it's too diversified, because us as an active manager, and I think we have our active share stats somewhere else, but essentially, at least for the our US equity strategy, which is again more 50 to 60 stocks, our active share versus the S&P is close to 90% versus the Russell value, it's about 85%. So I think once you, we don't want to kind of over diversify. We want to make sure that as a fundamental value investor, that the companies that we like are able to have an impact on portfolio performance, so that our winners don't kind of get too diluted by having a lot of names in the strategy.
Thank you. And I know you can't talk about specific stocks, but there is a question, so we can just kind of maybe talk in a more of a general sense. There's
Sure.
a question from somebody on why some of the tech companies and maybe some of the tech companies belonging to the Mag 7 are now considered value. So would you say that's true? And how would you think about this?
Yeah, so I would argue that potentially, yeah, so if I actually go back to 2022 and even 2023, we did own a few of them. We didn't own all of them. Right now we own, one of them, and this is probably public information. You can kind of look up, which one it is. I think for us, and we've sold out actually of a couple of our kind of Mag 7 names. So I think for us, it doesn't quite, kind of meet our valuation criteria. For the one that we do own, it's sort of what I mentioned before, is sort of when we look at kind of some of the intangible assets, kind of valuing that out, looking at it on a sum of the parts basis, we are able to find kind of a valuation discount there. But at least to us right now, I would say certainly in 2022, you can make that argument. At least for us today, we don't really consider them value stocks at the moment. I think why some investors might consider them, it depends on what they're projecting out as a growth, right? Sure, if you think that, this type of growth is going to continue for the next, 5-7 years, sure, it could be. I think for us, we are not necessarily sometimes comfortable projecting a lot of growth that far into the future. And so for other investors, again, that might have, more conviction in some of these, secular trends, AI, et cetera, might be more comfortable considering that a value stock if you think that, it's going to have kind of supernatural growth over the next, X many years.
Got it. All right, so I think we're almost at the hour, yes. And but I do want to maybe just touch on this. Could you share some insights on the most common mistakes value investors have made, and how as a professional investor you can go about avoiding them?
Yeah, so we have a slide on this kind of towards the end, where it's sort of some of our I guess some of our lessons learned. But yeah, so essentially, a few things. I mean, first, it's really that, macro uncertainty is really nothing new. And it's interesting. So our US strategy kind of launched back in 1991, and our US CIO, he kind of made a list of all the macro events that have been happening, since 1991. So there were a lot of them, right? Like Operation Desert Storm, Y2K, the tech bubble, 9/11, SARS. I mean, the list kind of goes on and on. And so I think there's sometimes a temptation to want to kind of move in and out of the market, based on those macro events. But if you look back, to 1991, the market has basically, you would have made, 24 times, your money. So certainly you have, ups and downs. But for us, I think over the shorter term, certainly macro kind of drives prices, but doesn't have a meaningful impact, kind of a longer term value. So I think of our lessons are really just to kind of stick to our investment discipline, try to not kind of get too freaked out by declining stock prices. We really want to stay anchored to our philosophy. I think another interesting example is kind of going back to the kind of the COVID period. So if you look back at the first quarter of 2020, we saw some stocks that, especially the economically sensitive ones, they were down 30, 40, 50, 60, in some cases for the energy companies, even 70%, right? So the question is, did your company value really just decline by 70%? Stock price fell by 70%. Does that mean your business value fell by 70%? If your business value fell by 70%, that means that there was kind of a permanent impairment on the business. And so, for us, when we look at our valuation modeling, we really think that most of the value is actually on years, 3 years and out. And so when we were looking at kind of the COVID period, it was thinking, okay, yes, there's clearly going to be an impact on cash flows over the next 1, 2, 3 years, but we think the world will mostly get back to normal, by 2022, 2023, depending on the industry. So with stock prices falling kind of as far as they did, that kind of provided, an opportunity. And certainly the stock market did, kind of rebound from there. So it's really to kind of, not be kind of fixated on the emotion of what's going on in the world and really sticking to our investment discipline. Also staying invested. We had also done some analysis on kind of selling at new market highs. I think there's a lot of kind of commentary around that. And essentially, our conclusion is that if you had sold all the new highs over the past, 50 years, you would have missed some of the major drawdowns, but there would have been many more signals that would have destroyed value. So if you had invested, over the past 50 years, if you had invested and if you had just stayed invested in the S&P for 50 years, you would have made 220 times your money. If you had instead sold all the new highs and waited to invest at a 5% decline, 10% decline, 20% decline, you would have made 10 to 20 times your money. And that is, again, as compared to 220 times your money. So for us, it's very difficult to try to, get in and out of the market. For us, we like to move to the parts of the market that are most attractively valued. And then, in terms of value, obviously this is what we're going to say because we're a value manager, but essentially for those investors, as you kind of mentioned in the beginning, that clearly there is kind of a narrow market leadership right now. So, it could be prudent for investors to kind of review their exposures. I know there's a lot of kind of excitement around AI, GLP-1s, et cetera. And there's a lot of these kind of value stocks that have been kind of left behind. But, there are, I think, some, as we kind of look at some of the outlook, there's some investor concern or expectation that market leadership is going to broaden at some point. So investors may wish to be prepared kind of for the potentially eventuality that will happen at some point.
Thank you. Can I just say that I love this slide? I feel like you've read my mind and just like put it into words, but better.
Good,
my favorite is lose the emotion, especially when there's commotion.
Yes, exactly.
It even rhymes, right?
Yes.
Yeah. I feel like we've been trying to tell this to our clients, but they're probably sick of hearing it from us. So it's good that, you feel the same way and that you're giving the same kind of advice. That's why you're a value partner. So thank you. Yep. These are great sayings, great advice. So I think we have about 5 to 6 minutes. So maybe, is there anything else that you would like to add that we haven't covered today?
We do have a slide kind of on some of the portfolio statistics, which might just be interesting to look at. And I think this is just more, it's a couple of slides. Oh yeah, this one. Yeah, I think it's just kind of nice to see that, despite the fact that the S&P 500 doesn't really look very cheap today, that there is the ability to be able to kind of construct a portfolio that's trading, around 12 times earnings, that's quite diversified across, industries and sectors, that there is the ability to kind of find a cheaper portfolio and also one that is, pretty high quality as well. So you can see that for our strategy, the PE is 12 times versus the S&P of 21 times and the Russell 1000 value of 16 times. But, the free cash flow yields are higher. EPS growth rate is lower than the S&P, but higher than the Russell 1000 value. So I think it's really just that, with all the talk about, new market highs, et cetera, that especially what we're kind of seeing with the divergence between high PE stocks and low PE stocks, that there essentially still is value to be had in investing in US equities. And we think that, we found, a lot of good companies to invest in.
Yeah, what I'm seeing here is the price to earnings is even lower than the Russell 1000 value.
Yeah,
It's quite
exactly. Yeah.
remarkable. Yeah.
Yeah.
Yeah. So I guess if I could just sum up kind of what Harris's strategy is, uh, you are able to navigate between the different styles of value investing so that the client, they won't have to pick and choose the different buckets themselves. And also if they're worried about, certain sectors going in and out of favor, you have Harris to kind of look forward and pick those that are going to make the most sense for the part of the market cycle that we're in.
Yep.
But that's my take on it. But I think maybe you can expand further, kind of
Yeah,
summarize what we
agree. I
talked about.
think, yeah, and there's actually a pretty interesting slide. There's a Morningstar slide here, which is kind of interesting as well, because it just shows kind of how our positioning has changed a bit over time, where essentially Morningstar, they basically categorize all of the stocks in the US equity universe as growth, value, or blend. And if you look back, sure which page, it might be a few pages before. But if you look back, our portfolio has tilted, yeah, exactly. So our portfolio at times has been a lot more core. And so this slide goes back over the past 10 years. So Morningstar basically, like for a portfolio, a strategy, they can basically aggregate, the value, growth, or core score for any portfolio based on like the weighted average of each of the individual components. And again, historically, yes, we have looked a little bit more core, a little bit more blend, even though philosophically we're quite value in our commitment to discount to intrinsic value. But right now, we're kind of more on the traditional value side, kind of more than that we've ever been. And that sort of speaks to how this is really where we are finding, the opportunity that we look a lot more like a traditional value manager than we really have in the past. But, certainly, when we have, I mean, our hope obviously is that a lot of these traditional value stocks, kind of start to do well, that we have maybe a potentially a market shift, market leadership change. And then if some of the, the growthier names start to reverse, then we have the opportunity to buy them. So it is nice, again, that we have the ability to kind of play in these different, types of investments, depending on what our team, finds really the most attractive.
Great. And maybe just to end things off, I have a difficult question for you. This is something that I often ask managers, and I get asked myself, which is, the U.S. elections are coming.
Yeah.
And depending on who wins the presidential election, whether it's Democratic or Republican or whatever, how do you think that's going to impact the strategy and investing in the U.S. equity?
Yeah, so in our view and in our experience, economic forces are always kind of stronger than political ones. So certainly the stock market often, reacts to a lot of these political developments. And sometimes that volatility kind of provides us actually kind of an opportunity to invest in some parts of the market that have been a little bit over penalized. But when it comes to kind of longer term, business value, we don't really think that it has a significant impact. So we don't really explicitly kind of, change our portfolio based on that. Certainly, different policy changes, et cetera, to the extent that that impacts, some of our names, we kind of model that into our portfolio. But generally speaking, we think that the stock price impact or the reaction tends to be a lot bigger than what we would estimate to be the impact on our kind of longer term company business valuations.
I think this goes back to lesson one, isn't it? Something about macro.
Yeah,
Yeah.
yeah,
Essentially, just think long term, just stay invested. Macro uncertainty is nothing new. And whether is, Mr. Biden or Mr. Trump in
yeah,
office, I think it's probably maybe there's some short term movement, but eventually markets will do what markets do, which is go
exactly,
up, go down. Yeah.
exactly.
Great. And I think with that, we've come to the end of the presentation, unless there are other things that you would like to add.
Nope, no, this is great. Thank you so much for the conversation.
Thank you, Laura. This was very helpful for me, and I hope it was helpful and great for the audience as well. And have a good evening, everyone. Thank you so much for your time.
Thank you so much.